I decided to break part one into two parts, so this is still periodic, but now I'm going to walk through the three different cost methods. Cost flow assumptions. First, we have specific identification. We transfer the actual cost of units. The next method we'll talk about is FIFO. Now, I'll actually walk through FIFO, which is the cost flow, not necessarily the flow of the units, but it usually follows normal flow of units, and that is first in is the first out, in terms of transferring cost to cost of goods sold. We then have LIFO, last in is the first out. Again, this determines when they go to cost of goods sold. And then the third method we'll be talking about is average cost. Determine a per unit cost by taking total cost of goods available for sale, dividing by the total units available for sale, and assign to units sold. Now we have a nice example here, and what I'm going to do is first take this example and put it in a format, and there are certain things I always do first. It doesn't matter whether I'm doing FIFO, LIFO, or weighted average, and I'll walk you through that. Step one, I take the information and separate what I have, which is total cost of goods in units and in dollars, and I take the units times the cost per unit, and then I add all of those up to get my total units and cost of goods available for sale. Next, if I'm going to need to do gross profit, I then figure out, okay, how much did they sell for, but I also, more than anything else, need to know of the 6,000 units, how many were sold. And in this case, I sold 4,700. I then take the 6,000 minus the 4,700, and I know in any inventory I have 1,300 units. Now here's what your goal is. You're now going to allocate the 117,000 between units sold and ending inventory. And when you add those two up, regardless of the method, they have to equal the total cost of goods available for sale and the total units available for sale. Now, periodic. The cost of goods sold is determined at the end of the month, so it is irrelevant when the items were bought or sold during the month. Now, I also would like to say that under FIFO, the only one, whether you're doing periodic or perpetual, you always get the same answer. Now, here is my example, and now what I'm going to do is figure out my cost of goods sold and my ending inventory. Now, when I do FIFO, I always start with the oldest units first. So I sold a total of 4,700. So I now have 1,000 in cost of goods sold at $12. Now I still have 3,700 left. So I'm going to go to my next layer. And I'm going to take that to cost of goods sold. Now I have 1,700 left, and I'm going to take them from the next layer. And that now gives me my total cost of goods available for sale. And my ending inventory is going to be 1,300 times $23. Again, when I add these two together, I get my 117,000. And my gross profit is going to be the 87,100 minus the 147,600, which gives me a gross profit of 60,500. Now let's do the same problem doing LIFO. Last in is the first out. Now, when we do LIFO, what we do is start with our most recent purchase. So we're going to take 3,000 at 23 for cost of goods sold. And we still have 1,700 left, so we're going to take them out of the $18 group. And it's going to leave behind 300, but 1,700 are going to go to cost of goods sold. Now we have our cost of goods sold. Now we can figure out our ending inventory. We add those two together. They give us our 117. And now we can figure out our gross profit. Now the last method we're going to talk about is the weighted average. Now with weighted average under periodic, all we have to do is figure out the unit cost once, which is total cost of goods available for sale divided by total units. Now, When you do perpetual, you have to repeatedly calculate the average cost because you have to do it at every time you made a sale. But with periodic, we only do it at the end of the month. So in our example, we take the 117 divided by 6,000, and that gives us an average cost of $19.50. And the inventory is going to be 1,300 units times 1950, giving us $25,350. Cost of goods sold is going to be 4,700 units times 1950, gives us 91,650. And again, we add them together, we still get our 117. Our gross profit is 55,950. Now, when we compare these three methods, what you'll notice is that cost of goods sold and gross profit and any inventory for weighted average always falls between LIFO and FIFO. Now, if prices are rising, FIFO will give you the highest gross profit and LIFO the lowest. And again, weighted average is always in the middle. This concludes the Part 1 presentation on inventory.